All right, let's just jump right into it. Welcome to this explainer. I am super pumped to have you here today because, let me tell you, we are going to decode a truly wild Q2 2026 earnings season in the fintech space. If you've been following the markets at all lately, you know it's been an absolute roller coaster. So today, we're going to look under the hood of modern finance by digging into three very, very different companies. Honestly, to set the stage, this quote pretty much sums it up perfectly. Earnings season hit like a Peloton instructor at 6 a.m. Relentless, a little painful, and somehow still going. The broader market environment has just been chaotic, right? The Fed just held rates steady for a fifth straight meeting. Crypto traders got completely humbled. Regional banks learned some unbelievably expensive lessons. And the legacy giants, well, they just kept doing what they do best. So here's our quick roadmap for today's explainer. First, the hook. Second, Coinbase's quiet market. Third, Coastal Financial's blow up. Fourth, Mastercard's moat. And finally, number 5, the big takeaway. Let's get into it. Starting off with Vignette 1, Coinbase's quiet crypto market. Let's kick things off with Coinbase. So founded back in 2012, led by Brian Armstrong, their recent Q2 report just dropped, and spoiler alert here, the market was definitely not thrilled. The stock took a pretty noticeable nosedive right on the print. Wall Street had modeled a revenue estimate of $1.31 billion, but the actual revenue, it came in at just $1.22 billion. That is an 18.5% year-over-year drop. Ouch. On top of that, they posted a GAAP loss of $1.36 per share. That was nowhere even close to the profit analysts were expecting. Now, what's really fascinating here is the whole diversification strategy Coinbase has been pushing. Basically, for the past year, management has been on a crusade to convince investors that they are way more than just a basic spot trading platform. They are leaning hard into derivatives, they're heavily pushing stablecoins through that massive USDC partnership with Circle, and they're expanding internationally. You know, on paper, it's a genuinely great story. But look, here's the unavoidable math for Coinbase. When Bitcoin and Ether cool off, retail volume simply dries up. It's just a fact. And when retail volume dries up, the core business bleeds. Diversification is awesome, but it absolutely did not save them from a really quiet Q2. Because of this, management actually narrowed their adjusted expense outlook to between $4.2 and $4.45 billion, which, by the way, is just classic corporate speak for we are battening down the hatches and bracing for a storm. And this brings up a pretty wild market dynamic. We just looked at Coinbase's struggles, right? A revenue miss, a GAAP loss, the stock dropping. But in the exact same week, Robinhood posted an absolute blowout quarter, and their stock barely even budged. It's a harsh reminder that the market really seems to have picked a new crypto-adjacent favorite, and it is not the company that IPO'd first. Coinbase is kind of finding out the hard way that a diversified fintech story is just a lot less exciting when your core engine is sputtering. All right, moving right along to Vignette 2, Coastal Financial's BaaS blow-up. Pivoting away from the high-flying crypto world, let's talk about Coastal Financial. They're a bank holding company out of Everett, Washington, and they built this incredible reputation acting as a sponsor bank. Basically, that means they provide the regulatory chassis for fintechs that don't actually have their own banking charter. Acting as the engine behind the CCBX platform, they've been a go-to bank powering this massive neobank and embedded finance boom we've seen lately. When things go right, it is an incredibly lucrative model. But man, here comes the gut punch. Coastal Financial reported a staggering $42.1 million net loss for Q2 2026. To really put that into perspective for you, this is a shockingly sharp reversal from just one single quarter earlier, when they posted $12 million in pure net income. Talk about whiplash. So how on earth does a highly successful sponsor bank lose over $40 million in 3 months? Well, the culprit was a $68.8 million credit expense, and it was tied to just one single partner relationship that went bad. It's essentially the banking-as-a-service version of a landlord finding out one tenant just completely trashed the apartment. Except in this scenario, the tenant's multi-million-dollar mess is now sitting dead center on the bank's own balance sheet, and they only expect to recover a fraction of it through their indemnification agreement. Rough. Which brings us to Vignette 3, Mastercard's winning infrastructure moat. Let's totally shift gears to a legacy heavyweight. Founded in 1966, currently led by CEO Michael Miebach, Mastercard is operating in just a completely different stratosphere right now. I mean, if you're a shareholder, their Q2 was an absolute thing of beauty. They beat across the entire board. Wall Street estimated $9.08 billion in revenue. They actually delivered $9.28 billion. That's a 14% climb year over year. Adjusted EPS, The consensus was 4.77, and they casually topped it with 5.04. Plus, that net income line jumped 21% to a massive $4.39 billion. Seriously, while Coinbase and Coastal had the kind of quarter that makes you panic check your portfolio, Mastercard was like a veteran point guard just calmly running the offense amidst total chaos. So, where is all this growth actually coming from? The answer is both sides of their business. Their payment network revenue rose 10%, which was largely driven by stronger cross-border volume. But look at this massive 20% growth slice. That's coming entirely from value-added services. We're talking about their fraud tools, their data analytics, and their consulting arm. This segment is really starting to look like Mastercard's true secret weapon for growth. And here's the thing. They aren't just resting on their laurels, passively riding consumer spending trends. Management gave us clear evidence that they are aggressively expanding the network itself. They flagged a brand new agentic payment capability, and they announced fresh major partnerships in both Mexico and the UAE. They are proving, beyond a shadow of a doubt, that their massive infrastructure moat is actively expanding into totally new territories.
All right, let's wrap this up with the big fintech takeaway.
So, we have just looked at 3 entirely different companies with 3 totally different quarters. What do these drastically different results actually teach us about the reality of fintech business models today? Well, on one hand, you've got Coinbase, bleeding because a quiet crypto market immediately crushes their core retail business, even with all their attempts at telling a diversified story. But then, on the other hand, you have Mastercard. Their quote-unquote boring infrastructure moat just keeps paying off and consistently printing money, literally no matter what kind of chaos is happening elsewhere in the fintech space. And we absolutely cannot ignore that brutal lesson we learned from Coastal Financial today. The banking-as-a-service model looks absolutely fantastic, right up until the moment it doesn't. It concentrates risk in ways that just do not show up on a balance sheet until one single partner goes sideways. And as we saw with that nearly $69 million credit expense, when that hidden risk finally rears its ugly head, it shows up all at once, turning a partner into a massively expensive liability overnight. Which honestly brings me to one final question I want to leave you to chew on today. Given all the chaos we're seeing in crypto, the hidden landmines hiding in regional banking-as-a-service models, and the just unshakable dominance of legacy payment rails, are crypto and card networks really the same trade? It's a provocative thought for sure, and one you should definitely ponder the next time you're evaluating the fintech ecosystem. Thank you so much for joining me for this explainer. I really hope it gave you some powerful new frameworks for understanding the market. Keep learning, and I will see you next time.